Yeah, good afternoon. My name is John Higginbottom. This is Graham Jones, both from the policy and technical team. Today we're hopefully going to talk about some of the budget changes that have happened from George Osborne's discussion yesterday. So Graham, if you could quickly for today just run over some of the key changes that happened yesterday.
I think one of the key changes was obviously an increase in the personal allowance and announcements regarding the freezing and the phasing out of the age-related personal allowances, which will give interest to a few clients.
Yeah.
There's been a few hidden things in there as well that we didn't expect, such as changes to the qualifying policy rules, which is going to sort of limit the scope for high earners, higher taxpayers to pay into products like MIPs.
Well, how's that going to be impacted? Is that going to be an immediate change, or is it going to be one for next year?
Well, initially, I mean, it affects all policies issued after the 6th of April 2013, but it will also have an impact on premiums paid into policies between now and that date. So what will happen is that there'll generally be a cap of 3,600 on which, in terms of premiums that can be paid into these plans, and premiums paid into plans that are set up this year.
So that's new plans from now onwards, essentially?
Yeah.
So it's going to be okay for existing plans that are already in place?
Yes, it will be, yeah.
Right. In terms of the cap, what are they looking to cap? Are they?
They're looking to basically cap the amount of higher rate relief that you get on the policy proceeds. So whereas MIPs and qualifying policies were a bit of a tax haven for the higher and additional rate taxpayers, that's not going to be the case going forward.
So if you pay over £300 a month, effectively you lose the qualifying status, I guess.
Yeah, and that's important to say, that's cumulative as well, so that's not just one policy, that's all the qualifying policies that you may be paying into.
That certainly sounds like quite a key change for certainly the higher rate taxpayers. Any other changes that have happened?
Well, there's some stuff that we expected anyway, so that's been announced in the autumn statement. So there's changes around the QROPS rules, introducing a new 10-year reporting period, which will potentially affect some clients.
And also about the New Zealand scheme being potentially shut down as well.
Yes,
So
yeah, that was another change
options,
that was brought in and announced early on. There's also the reduction in the lifetime allowance to 1.5 million from 6th of April. Again, it's a case of that will affect anyone that doesn't or can't apply for fixed protection and doesn't have any other form of protection.
Right. So fixed protection still got to the 6th of April to apply for that, those who need it.
That's it. Yeah, I believe the form's got to be on the HMRC doormat by 5th of April, or you'll lose opportunity.
So there may be some urgent running around going on then too. So what other key changes will have happened?
Well, a lot of the stuff that's come out was actually effective from next year. So we've got an announcement to reduce the tax rate from additional rate taxpayers to 45p, but that's from next tax year, not from this April.
So no urgent pension planning maybe yet, so just can wait a little while for that one.
That's right, yeah. We've also got changes to child benefit rules. So whilst they don't come in until I think it's the 1st of January of 2013, the reduction of child benefit will start to bite if you've got someone earning more than 50,000 in the household, and that 50,000 figure will be based on taxable, well, the income for 2012-13. So there's potentially some scope there for financial planning
because that's quite a change from what we were expecting prior to that, which was just higher taxpayer. So they've not really solved the two high earners from the issue, but they have tried to move up the band by the sounds of it.
Yeah, I think that's a bit of a consequence of reducing the base rate tax threshold, bringing a few more higher rate taxpayers into the equation.
Very true, yes. So I guess, like I say, there's going to be a lot of planning around that, so like maybe salary sacrifice and all such items like gift aid may come into effect. Any other key changes?
I think what we'd say is probably what didn't happen was equally of note. So it was largely anticipated that there would be a reduction in the annual allowance, perhaps to £40,000, the pension annual allowance, or a removal or a restriction somewhere of high rate tax relief on pension contributions. So we thought pensions were going to get hit again. It didn't happen, fortunately. But what did happen, there was some general tax avoidance measures, and the chancellor's announced that they're going to bring in some rules to restrict uncapped tax relief. So pensions, EISs, VCTs, all those types of reliefs are currently capped, so we don't need to worry about those. But there are other types of uncapped income tax reliefs that the government will look to restrict.
Such as?
One that springs to mind for people who perhaps partners in their own partnership, and that partnership generates a loss. currently you can use sideways loss relief to offset those losses against income you've got elsewhere. So you can see perhaps things like that being
So on the basis that it's only limited by the size of the loss, therefore the loss could be uncapped, and therefore
Yes.
the uncapped loss relief. Right, yeah, no, it makes sense.
So I think the headline news is that the next year the 50p rate will come down. Obviously there's a few things with the qualifying policy rule. There's a tax avoidance measures to sort of get these high earners by the back door, I think, raise revenue other ways.
I think the final thing they talked about was stamp duty.
Yes,
What
that's
briefly
right,
changed, or what is changing, or what has changed on that very briefly?
Briefly, they've sort of introduced a super rate, 7% for properties over £2 million. So it's largely not a lot of planning you can do around that. Probably the other issue is a 15% stamp duty tax rate for, again, properties over the same threshold of 2 million, but that are bought by what they call non-natural persons, i.e. companies, to stop people wrapping up properties within corporate structures. And
This is the way they're doing the classic planning of avoiding stamp duty tax relief in the first place. So,
and I believe that they're also going to potentially introduce an annual charge on properties held within corporate vehicles,
right,
residential properties. So that might be something that hits some clients.
there might be some planning around that one. Well, thank you for the update. Much
No
appreciated.
Thank you very much.
I hope you found that useful. If you'd like any further information, please do contact our team of experts in the Bankhall technical team on 0845 300 5326 and select option 4. Any of the matters you want to discuss, we'd be more than delighted to discuss them with you.